Hi everyone, I'm Idayu. So today I'm going to share with you on the uh, so-called principles of accounting, which are emphasizing on the 6 types of accounts. Okay, so basically when we talk about basic accounting or principles in accounting, so we are emphasizing on the 6 types of accounts. So in accounting, we will group our business transactions, okay, into all these accounts. And the number 1 until number 5, which consists of asset, liability, okay, capital or equity, revenue, expenses. And the last one, this one, on the withdrawal points, and later I will explain to you how this account affect your capital or equity. This is a very special account. All right, so let's go to the first one, which is your asset. So in your asset, if a business has an asset, it shows that the business has resources, right? The business has resources, and normally when the business acquire an asset or when the business own an asset, the business will use this asset to generate revenue. For instance, the company will purchase land, right? So on the land, they will develop their plant or their factory. So you produce your goods, your product on the factory, using the factory, which is on the land. And then you might also acquire machine, right? A company will purchase machines. So when you use this machine to produce your goods, right? So it is in a way of producing revenue or generating your revenue, business revenue or your sales. Okay, that's on asset. So further, this asset we will divide into 2 types of asset, which is current asset and non-current asset. So you have 2 types of assets, okay? Current asset and non-current asset. What are the example of current assets? Cash and business cash, the bank accounts, trade receivables or account receivables, prepayments. Okay, later somehow in your syllabus you will see these prepayments. Okay, so for the basic, the principles one, I won't touch much on these prepayments, okay, or accruals. So when you have this current asset, it shows that you have a liquid asset. What does it mean by liquid asset? You have an asset which is easily to be converted into cash. Okay, so guys, as you can see, you have your cash. So of course, it's very liquid asset. And then you have the bank account. I think nowadays within a split second, we are going to lose our money because we spend through our bank account, right? And then we have the trade receivable. So what is trade receivable or account receivables? You sell your goods, your product, or your service, your services to your customer. Your customer is not able to pay on that time. They'll pay later, right? They'll pay later. So you are going to collect this credit sales, we call it, yeah, from your customer in the future, not now, right? We are not talking about the person. We are talking about the money that this person owe to our business, yeah? So we are going to chase them to collect those sales. So it's going to be our asset. The money that they owe us, the amount owing by the customer to the business, that is our current asset. Next is non-current asset. So non-current asset, of course, it's not easy to be converted into cash. For example, you have land. Sometimes you take years, right, to sell the land, machines, building, business premises, offices, factory, plant. Okay, so that's on asset. Now I move to liability. The easiest way to understand the concept of liability is when the business owe other entity. Okay, the business has amount owing. The business has debt. So same goes to asset. This liability also further can be divided into two, which is current liability and non-current liability. So when you talk about current liability, you have amount owing that you should settle within 1 year. So in accounting, basically, we presume that the short term, it's going to be within 1 year. Yeah. More than 1 year, it's going to be a long term. Unlike finance, finance normally, the assumptions on the short term is within first 3 years. So now accounting, when you prepare the report, the statements, okay, so less than 1 year, it's going to be our short-term period measurement lah. Example, you have amount owing to your supplier. We will record it as your accounts payable or trade payables, right? Let's say you produce a table. You need wood, okay? You need maybe the steel, or maybe you need a paint. I just give a very simple example. You need the wood to produce a table. Okay, your company sell tables, furnitures, for example. So you purchase the wood from the wood or the timber suppliers. So when you buy this wood, you cannot pay on that time, you pay later. So the concept of this amount owing to the supplier, yeah, in accounting, we have to maintain trade payables account or accounts payable. It is the opposite way of treating our account receivable just now. If account receivable, we sell goods to our customer and our customer is not able to pay on that time, they will pay later. So when you have trade payables or accounts payable, now our business or our supplier, our business or suppliers. So we have that. So we have to pay those amount owing. So the amount owing is your current liability, right? Some countries, they still have the short-term loan, right? And then in future, you will learn on payables, accruals. Okay, that one is on your future topics. And then non-current liability. So if you have current liabilities for short-term, so non-current liability, it represents a long-term liability. Okay, more than 1 year. Now I move to the third items, capital, or we can call also as owner equity or equity. Okay. This capital is purely talking about the fund, the money, the asset that being contributed by the owner when you start up your business. So that's the keyword. As the owner, you invest money. It could be cash. It could be in terms of asset. Okay. To start up the business. You want to start a business, you need funds, right? You need cash, definitely. And then let's say you have a vacant building, so you want to make or to produce your goods or product in this building. So you introduce the building and to be so-called your factory or the plant for you to produce your goods. And then you sell the goods. So this explains the concept of capital equity. So basically, when we have these three components, okay, it will be included. Yeah, these three will be included in preparing our statement of financial position, or I used to call it as SOFP. Okay, I used to call it as SOFP, Statement of Financial Position. So when you prepare this statement, it is a final account. Okay, it is a so-called report, which is very, very important. Okay, to explain about the financial health, the financial positions of the company, which consists of asset, liability, capital, or equity. Okay, so we need all these three items or these three accounts to be reported inside our SOF FP. Okay, that's on asset, liability, and capital. So this, normally I will draw a line here so people know that we are going to have these three components in preparing our what we call it, in preparing, okay, maybe I can put a box here. Okay, in preparing our SOF. Okay, next, I explain on component number 4, number 5. Okay, these two representing the items that will be involved in preparing our statement of profit or loss. Okay, I used to call it as SOPL. Right? These two items, we need it to produce our statement of profit or loss. So what is revenue? The income. How does a business generate income or revenue? When you sell your products, your goods, just now we produce a table. So companies sell the table to their customers, so they collect the sales, right, from their customers. So that is their income. So if you ask me, when we explain about revenue or income, it is inflow of money because you collect those sales from your customer. Okay, so that is your revenue. Example, we have provided printing services, right? So printing services revenue. Okay, let's say you have an accounting or audit or taxations services, professional services, right? So tax service revenue. If you sell furnitures, so you sell this furniture, it's become your revenue. It's become your income items. So that's on revenue. Expenses, you need to expense, you need to pay something to produce your goods, your product or services. That is expenses. Okay, so when we explain revenue inflow, so expenses, we have to pay. So an outflow of money. So we put it these two items in the SOPL, right? So it's gonna be revenue minus your expenses. R is revenue, E is expenses. Revenue minus expenses. So when we have this, at the end, we are going to see the final result, which if you have a positive result, meaning your revenue more than expenses, you're going to have profit. Okay, business is making profit, or some book they call it as income. So total revenue minus total expenses, you will get net profit or net income. So the other way around, if my expenses higher than my revenue, expenses more than revenue, I will have a loss. Okay, so total expenses higher than total revenue, I'm going to have net loss. All right. So for a small micro enterprises or any sort of business, this two statement is a must. Okay, for the tax computations, even for the micro enterprises, small enterprises, they need to prepare these two statements. That's why this two statement is very, very important. It is the two components of your financial statements, right? We have 5 components of financial statements: statement of profit or loss, statement of financial position, statement of cash flow statement, statement of cash flow, statement of changes in equity, all right? And the last one is your notes on financial statement. So done with the preparation of SOPL, which consists of this element. revenue and expenses. All right, the last one, withdrawal or drawings. This account is very special. Why? Only the owner, the business owner, can have this withdrawal or drawings. What is this withdrawal and drawings? As a business owner, I can take cash of the business. I can take the asset of the business. Why I can do that? Since, remember, capital or equity is the introduction of cash or asset by the owner on the day one you start your business. So at any time, as the owner, I can take back my money. I can take the business cash. I can take the asset for my personal use. For instance, I took the cash of the business, okay, and I want to pay for my house electricity bill, utility bill. I want to pay for my kids' tuition fees. So paying kids' tuition fees is not related to business at all. So I need to declare because I'm using business money, which I already invested on the day one I start my business. So I need to have this withdrawal or drawings account. So indirectly saying that when you have this drawing, it's going to reduce your capital or equity. The more cash you take, the lesser will be your capital, your equity. All right, remember, withdrawal, you take the cash or the asset of the business for your personal use. So that is withdrawal or drawings. All right, that's on the 6th type of account. Further, if you go to the maybe a bigger company, they will treat on this provision account. I think across the syllabus, we will see it somehow. Okay, next, I want to introduce you with the accounting equation. So if you can see this, A stands for asset, L is for liability, and the C, or some book they call it as E, equity. Okay, so ALC, actually just now it represents these three components which we should report in statement of financial position. Okay, so this is for accounting equation. Very, very significant to the accounting. Okay, so to explain about this asset, liability, and capital, I would like to introduce you a concept of double entry. So when we have account, basically we will record this account in a ledger. So our ledger, it will looks like a T account. As you can see here, I have a capital letter of T. So I have this side, which is on the left hand side. And for this side, I have the green one, which is on my right hand side. Okay. For this yellow, which is the left hand side, the left side of this T account. So this is what we call as debit side. Okay, this is what we call as debit side. And for my right side, we are going to call it as credit side. Okay, so as you can see, I have this T account. On my left side, I address it as debit side. On my left side, I address it as credit side. Okay, so now let's continue with the concept of this accounting equation. Actually, when we have these three components, you don't have to memorize all the three. I would advise you to memorize only one to memorize? Okay. You should memorize this way. Asset always increase, goes up on the debit side. Asset always increase, goes up on the debit side. And we have only two sides, right? Of course, asset will reduce on credit side. Asset will reduce on the credit side. In accounting, we don't have any more other sides, yeah? Only the debit or credit. So this is your double entry actually. So all asset account, let's say you have cash, you have bank, you have trade receivables, you have stock or inventory, or just now I didn't introduce this stock or inventory. Okay, it is also under current asset. What is stock or inventory? Those products that you want to sell to your customer. Okay. So asset always increase on debit, asset always reduce on credit. So as you can see, we have this equivalent sign here, this symbol, right? So your asset always equal to your liability plus your capital. This is an equation. So let's say on my side of asset, I put it here, I have 100. Okay, I have 100. So definitely have the equal, right? I have the equal. So definitely on my liability or capital, I should have a total of 100. Then only it will be equate, right? Equivalent. 100 equal to 100. Okay, that's how this accounting equation should explain the relationship between the asset, the liability, and capital. Okay, now I already introduced you on the double entry of asset. You should memorize. Asset always increase on debit, always reduce on credit. You just memorize one side. The other side definitely should be the opposite. Here goes up, here goes down. So you memorize asset increase on debit. That's it. So when you have this equivalent, this side, okay, I put this color. Okay, this side, it should be the other way around. If my asset increase on debit, when I go to my liability, it should be the other way around. Which is, okay, let me rearrange this one. When I have my liability, it will increase on credit side. So as you can see, equivalent, right? So I have this side, the orange side. So definitely my capital also will be increased on credit. These two components should have the same nature. Okay, these two components should have the same nature, liability and capital, increase on credit. And of course, as we have the debit and credit, right? Increase on credit. So meaning liability reduce on debit. Same goes to capital, increase on credit, so it will be reduced on debit. So you just memorize your asset. Asset increase on debit. That's it. That's all. Then the other two components after this equivalent sign, we have this equation, right? So this part should be the other way around. So you just memorize asset and then you reflect accordingly your liability and your capital. Okay? That's how this double entry works. So that's on your accounting equation. Explain or relationship with the double entry. We will have this revenue and expenses. Okay? So if I have revenue and expenses, the nature is similar to your asset and liability. Okay, show you the total effect. Okay, that one is on accounting equation. So what about your revenue and expenses? Because we got 5 types of account, and then in additions we have the withdrawal. Okay, maybe I can explain also on the withdrawal. Okay, expenses. Expenses always increase on debit. Why? Because when we prepare this SOPL, we want to see whether the business is making profit or loss. And then who will enjoy this profit or loss? For your information, we are going to send this profit or loss to our capital. Why? As the owner, when your business has profit, you'll be happy, you should enjoy it. So the more money you make, right? So this extra money, which is come from your profits, will go to your capital or equity. So in other words, when we have profit, our capital will be increased, goes up. So the other way around, when we have loss, our capital will be reduced. Okay, so that's the first thing to explain about the double entry of revenue and expense. So to compute this profit or loss, we compare these two items. We compare these two accounts, the revenue and expenses. If I have more revenue, I'm going to have more profit, more capital. So I can say that this revenue in nature should equivalent to the nature of capital. Meaning, when my capital increase on credit, my revenue should be increased on credit as well. Okay? When my capital increase on credit, make it smaller, capital increase on credit, revenue should also increase on credit. Remember just now, you have revenue, profit will increase your capital. So if you ask me what is the double entry of profit, profit always increase on credit because it's follow the nature of capital. When you have more profit, you send to capital. Okay, so your profit should be increased on credit, follow the nature of your capital. Revenue increase your profit or increase the tendency of making profit, right? So your revenue should also increase on credit. So if my revenue increase on credit, expenses is the other way around. As you can see here, expenses is negative sign, meaning it will reduce your revenue. When you have more expenses, more and more, higher tendency of making loss, right? So I can say that my expenses will increase the tendency of loss. It will reduce my capital. Or in other words, loss will reduce capital. Since capital increase on credit, if I have loss account, if I want to treat this loss, so my business loss will increase on debit. Profit always increase on credit, loss always increase on debit. So my expenses, which will increase tendency of loss, will reduce my capital, right? When you have loss, your capital will be reduced. So expenses should be increased on debit. You see the other way around of this, right? Because these two is related. Okay, so that's double entry for revenue and expenses. Meanwhile, for withdrawal, okay, for this withdrawal, again, withdrawal owner took cash or asset for his or her personal use. Then this withdrawal or drawings will reduce the capital. Okay, it will reduce your capital or your equity. So just now, capital increase on credit, withdrawal will reduce capital. So the other way around, it will reduce the capital. So that's why withdrawal increase on debit, reduce on credit. Okay, so basically this is a double entry. In other words, when you talk about account equation, firstly, you must memorize your asset. Asset always increase on debit, so any liability or capital account increase on credit, and then the other way around. The reduction on the other side. Expenses will reduce capital. So capital increase on credit, expenses increase on debit. Revenue will increase capital, so capital increase on credit, revenue will increase on credit. Okay, that's on double entry. All right, now I want to explain a bit on the effect of accounting equation. Right? So just now you get the idea, the asset will increase on debit, the asset will reduce on credit. And then your capital will increase on credit, it will reduce on debit. Meanwhile, for liability, it should be the same nature with your capital. Okay, I give you a simple example. Now I want to reflect the effect on the accounting equation. Okay. Okay. First, business owner introduce 1,000 cash to start up the business. Business owner introduce 1,000 cash to start the business. So when you have this accounting, when you have these transactions, firstly, you must know what actually account represent this transaction. So I can see that business owner introduce cash. So cash is asset, right? Current asset. So asset, which is the cash. So asset of the business will goes up, increase. Okay. So if I show my accounting equations, my asset will be increased by 100. 1,000. 1,000. Maybe at this stage, I don't want to explain about the double entry. Okay. I just want to show the effect of on the accounting equation. So cash just now is asset. Okay. It's on the asset. So my asset goes up. My asset increased by 1,000. I should be positive sign. Okay. So plus 1,000. So, okay. So I have the 1,000 increase in my asset. Okay. And then just now the concept, asset is equal to liability or capital. And for the account equation, I don't have any L here because I don't have liability. So my liability, technically, it is 0. And then we have the plus. So definitely this side, 1,000 plus, and plus 1,000 or increase in my asset should equal to, for this side, and this, the L and C also must be increased by the same amount. So of course, my capital will be increased by 1,000 because as the owner, I start my business, I introduce cash. So asset increased by 1,000, capital increased by 1,000. Here is positive, here is positive, equal. Okay? Don't relate with the debit and credit. I go by the effect on accounting equation. Okay. Let's say the business purchase new asset. Let's say business purchase machine cost 500 ringgit using cash. Using cash. So cash is asset. So my cash reduced by 500. Oh, plus cannot, minus can. Okay, so I have used my asset because my cash reduced. So I have 500 reduced in my asset, right? Why asset reduced? Because I'm using cash. So this 500 actually representing reduction in my cash. So my asset reduced by 500. Then I use this cash to purchase a new machine, right? So this machine is asset, non-current asset, because when you purchase machine to produce your goods, that is your asset, business asset. And you don't purchase or acquire machine every day, right? You keep it for a long period. We don't buy house, we don't buy premises, we don't buy land every day. So same goes to the business. So we don't buy machines just to keep for a day. Hopefully it may last longer than that. So when I purchase machine just now using cash, business cash, the asset reduced by 500, I get the machine, right? Because I buy the machine. So my asset should increase by 500. So now when I show this accounting equation, okay, minus 500 plus 500. So actually it's become 0, right? Minus 500 plus 500. So it will be 0. So 0 equal to 0. Because I don't have liability or capital for this transaction, right? Business use cash. So cash of the business reduce to purchase machine. So machine is asset of the business. Asset goes up. One reduce, one increase. Okay. So minus 500 plus 500. So you get 0. So A is 0 equal to 0 on your L and C because I don't have any liability. I don't have any capital here. So accounting equation is balanced. Okay. All right. Further, I give you example on liability. Business has sufficient cash, okay, to purchase or you don't have money to, or very simple, you want to start a business, you don't have fund, you don't have cash. So you go for loan. You ask or you apply loan from the bank, right? So you get the money from the loan. Your bank approves, so you get the money. So let's say it is a 10,000 cash that you receive from the loan. Okay. So when I receive this money, so it's going to be my cash of the business, right? So my cash is asset. My asset goes up by 10,000. Okay. My asset goes up by 10,000. So now if I look at the accounting equation, my A is 10,000. It should be equal to this, to our capital. No, remember just now I told you when we talk about this capital or equity, it is an introduction of cash or asset by the owner. Now you get the money from the loan, from the bank, not the owner. So when you have this loan, the loan is a liability. Why? Because you have debt. When you have loan, you have debt. Okay? You have obligations. So my liability will be increased by 10,000 as well. So technically, asset 10,000 goes up, and for my loan also, I have increased in my liability by 10,000. So 10,000 asset equal to 10,000 of loan. Here is positive, goes up. Here also positive, goes up. Asset increase, liability increase. So we have equal. 10,000 equal to 10,000. So that's how your accounting equation works. Okay? So somehow these are the effect on the accounting equations. Huh? All right, I think that's all for now. Okay. Hopefully, this sharing would help you to understand better, okay, about the basic accounting principle. Thank you.